Okay, so you want to own a bank. On the surface, it sounds like the cleanest business model imaginable. People hand you their money, you lend it out to someone else at a higher rate, you pocket the difference, and you do this millions of times over until the numbers become almost absurd. That is, more or less, what a bank actually does. What almost nobody explains up front is what it costs to get permission to do it, what happens the moment the math turns against you, and why some of the most experienced bankers in the country have watched institutions they spent decades building disappear in a matter of hours. Let's start with what a bank actually is, because most people picture something closer to a very secure storage room. You bring your money in, someone guards it, you take it back out whenever you want. That's not a bank, that's a locker. A real bank is a machine that converts other people's deposits into income-producing assets. The instant your money lands in an account, it stops sitting still and starts working somewhere else entirely. A farmer takes seed and turns it into a harvest. A refinery takes crude oil and turns it into fuel. A bank takes deposits and turns them into loans, bonds, and investments that generate income every single day. And the genuinely strange part of this business, the part that makes it unlike almost anything else in commerce, is that when the bank lends your money out, your money hasn't actually gone anywhere, as far as you can tell. You can still log in, still see the balance, still withdraw it tomorrow. Meanwhile, the bank has already lent the overwhelming majority of it to someone else entirely. This isn't a trick or a scandal. It's called fractional reserve banking, and it is quite literally the foundation the entire modern economy is built on. Here's the mechanism in practice. A depositor puts $100 into a bank. Historically, that bank was required to keep a set percentage in reserve, commonly around 10%, and could lend out the rest. That $90 gets spent. The recipient deposits it somewhere else. That second bank keeps its own small reserve and lends out the remainder, and the cycle repeats itself dozens of times over. A single deposit can eventually support many multiples of its original value, circulating through the economy, not through anything magical, just through the compounding math of a system built entirely on the assumption that not everyone asks for their money back at the same moment. In more recent years, the Federal Reserve actually eliminated formal reserve requirements altogether, shifting the regulatory emphasis instead toward capital adequacy, which we'll get into shortly, but the underlying principle hasn't changed at all. Banking runs on trust, full stop, and the entire system holds together only as long as the overwhelming majority of depositors keep behaving as though their money will always be there when they want it. So how much does it actually cost to start one of these? This is where the fantasy usually meets its first wall. Before you've accepted a single deposit or issued a single loan, you're realistically looking at somewhere between $2 and $30 million in upfront costs, depending on the scale and type of institution you're building, and somewhere between 1 and 3 years of pure regulatory process before you're even allowed to open the doors. You need a charter, either federal or state, and you need to separately obtain deposit insurance, and both of those applications demand exhaustive documentation covering your business plan, your management team's qualifications, your risk framework, and detailed projections showing exactly how the institution plans to remain solvent under stress. Regulators aren't simply checking whether you have money, they're evaluating whether your entire plan is coherent enough to survive contact with reality. And then there's capital, which is a completely different concept from deposits. Deposits are money the bank owes back to its customers. Capital is money that genuinely belongs to the institution itself, the cushion that absorbs losses before depositors ever feel a thing. Large banks currently need to hold capital equal to roughly 4.5% of risk-weighted assets, plus an additional buffer on top, while smaller community banks are typically expected to maintain a leverage ratio somewhere around 9 to 10%. In practical terms, a small community bank aiming to support a $100 million loan book needs to walk in the door with something like $10 to $15 million of genuinely owned capital, money that can't be borrowed and can't come from deposits, before a single loan officer has been hired or a single lease has been signed. Once you're actually open, the costs don't slow down, they multiply. Payroll alone for even a small community bank runs into the millions annually. Once you account for loan officers, compliance staff, risk managers, branch employees, IT and cybersecurity teams, and senior leadership, and at the largest scale, that number becomes almost incomprehensible, with the biggest institutions in the country spending tens of billions of dollars a quarter on operating expenses alone. Technology is its own enormous category, since every transaction has to be recorded, verified, and protected against constant, relentless fraud and cyber attack attempts, and a single serious data breach can cost hundreds of millions of dollars in fines, legal exposure, and lost customer trust. Compliance sits right alongside it as one of the heaviest recurring costs in the entire industry, since banking carries anti-money laundering obligations, fair lending requirements, consumer protection rules, and regular stress testing, all of which demand armies of specialized staff and legal counsel simply to stay within the lines regulators have drawn. And finally, there's the cost baked into lending itself, since every institution knows in advance that some percentage of its loans will eventually go bad and has to set aside reserves against those expected losses well before the losses actually materialize, a provision that can quietly consume an enormous share of what would otherwise be profit in a difficult year. So where does the actual money come from once all of that is paid for? The core engine of any bank is something called net interest margin, the spread between what it costs to borrow money from depositors and what it earns lending that same money back out to borrowers. Borrow cheaply, lend expensively, keep the difference, and at genuine scale that thin spread turns into enormous sums, since a bank earning even a modest percentage margin on a loan portfolio in the hundreds of millions or billions of dollars is generating real money purely through the multiplication of scale. But lending is far from the only revenue stream a modern bank has built. There are account maintenance fees, wire transfer charges, foreign exchange fees, and overdraft fees, which alone generated close to $10 billion in a single recent year across the industry, despite growing regulatory scrutiny over how predatory that specific fee structure can be. There are interchange fees collected every single time a customer swipes a debit or credit card, a tiny percentage that becomes genuinely significant money across billions of transactions. And at the largest institutions, there's investment banking and wealth management, advising on mergers, managing assets for wealthy clients, and trading securities, businesses that can swing enormous quarterly revenue numbers on their own. The largest bank in the country posted a full-year net profit in the tens of billions of dollars in one recent year, a figure that exists purely because of scale, since the margin on any single loan is genuinely small, and it's only when you multiply that small percentage across trillions of dollars in assets that the number becomes almost impossible to picture. Here's what actually makes this business fundamentally different from nearly everything else in commerce, and it's the same thing that makes it so dangerous. A restaurant owner uses their own capital and hopes the margin on food covers it. A bank operates almost entirely on money that belongs to other people, borrowing deposits cheaply and lending them out at a markup, generating a return on capital it never actually put in itself. That's leverage, and it's simultaneously the source of banking's extraordinary profitability and its extraordinary fragility. A bank earning a small return on a massive asset base can post a genuinely enormous return on its own actual equity, sometimes reaching well into the double digits, a level of return almost no other industry sustains consistently, but leverage cuts both directions with equal force. When loans default, when bond values fall, when markets seize up, those losses don't hit depositors first. They hit that thin sliver of equity capital sitting at the bottom of the balance sheet. And a bank whose losses exceed that cushion is, by definition, insolvent, regardless of how much it owes its depositors on paper. History has demonstrated this collapse mechanism with brutal clarity more than once. A major American savings institution that had spent nearly 2 decades growing into one of the largest in the country pushed aggressively into higher-yield, higher-risk mortgage lending during a housing boom, a strategy that looked entirely rational as long as home prices kept climbing. When the housing market turned and a major investment bank's collapse sent shockwaves through the financial system, depositors panicked and pulled tens of billions of dollars out of that institution within roughly a week and a half, more than a tenth of its total deposit base, and regulators seized it and sold it off for a fraction of what it had been worth just months earlier. More recently, a bank serving the technology and venture capital sector saw its deposits roughly double in a single year during a startup boom, took much of that new money and invested it in long-duration government bonds, a genuinely safe asset class on its own, but one that loses value when interest rates rise. When the Federal Reserve raised rates at the fastest pace in decades, that bond portfolio's paper losses ballooned into the billions. And once the bank disclosed it was selling assets at a loss to raise capital, word spread through tightly connected venture capital networks within hours, not days. Depositors attempted to withdraw a staggering share of the bank's total deposits in a single day, and within roughly 44 hours from the initial announcement, regulators had seized an institution that had operated successfully for 4 decades. Neither of those collapses happened because of one dramatic, obvious mistake. They happened because the entire business model runs on a mismatch between how quickly deposits can leave and how slowly the assets backing them can be converted back into cash. A mismatch that can look completely stable for years and then unravel within days once confidence genuinely cracks. So if you do decide you want to own a bank, understand precisely what you're actually buying. You're not buying a vault, and you're not buying a smooth, predictable income stream. You're buying a machine that converts trust into money, one that performs beautifully for as long as that trust holds, and can come apart faster than almost any other business on earth the moment it doesn't.